Well, thank you, ladies and gentlemen, all for coming along. On behalf of the Securities Association, well, I'd like to thank, on behalf of IG, should I rephrase that, thanks for the Securities Association for letting IG and Daryl come along and speak today. I hope you all guys get something out of what we have to say. I will just disclaim before I start my presentation that nothing I say today should be considered personal advice. I do not know any of your circumstances whatsoever. Please use what I talk about as a backdrop for your existing strategies. Okay? I'm going to be talking more of a macro theme, more of a macroeconomic theme, how markets are correlated at the moment. I'm going to talk a very top-down specific focus. So I'll be talking about the currency markets, I'll be talking about the bond market, I'll be talking about indices, and I'll be talking about commodities and how they're all interlinked at the moment. I will not be talking about individual stocks. So I know a lot of you out there are long-term investors, so perhaps some of this top-down macro issues will be affecting some of the companies that you guys are looking at the moment. But yeah, use this as a bit of a background. But before I start, and really don't be shy whatsoever, I just want to sort of get a gauge about how I should pitch this seminar and what sort of levels you guys are at. Can I have a show of hands for people out there that would consider themselves traders? Who would you, if you trade more than once a week, put your hand up in the air, regardless of what asset class, whether it's stocks, currencies, commodities, traders. I just want to sort of guess. Okay, there's quite a few out there, so that's good. Most of what I'm going to be talking about will be short-term focused. I am a short-term trader myself. I trade on behalf of IG Markets, on behalf of clients. And I think Daryl will be giving you some strategies and some psychology which you can hopefully take away and use in your existing strategies as well. So who's this random English bloke who's standing up in front of you, telling you what's going to happen? Well, my name's Chris Weston. I've been in the financial markets now for about 15 years, despite my extremely youthful complexion and look, so I have been in the markets for some time. I started my career at a US investment bank called Morgan Stanley as an equities trader. I then subsequently went to Credit Suisse, a big Swiss investment bank, and then I went to Merrill Lynch where I was a money market and foreign exchange trader on the buy side before coming over to Australia where I've been on the institutional desk, and now I head up the research team. So I provide a lot of research to clients. You can actually go to the website and you can see some of the research that I provide with my team every day on different macroeconomic and related issues as well. I do a lot of the TV commentary on CNBC, Bloomberg, and more recently The Apprentice. So some of you may or may not have seen that. Myself and Daryl were involved in trying to teach the contestants how to be profitable and how to manage their risks in this market. So as I say, I'm going to really talk about different macroeconomic themes, what's going on. But for me, the most important thing is understanding how central bank action at the moment is dictating play, and how central bank action is dictating what's happening in the bond market globally, how that's affecting the underlying currency, how those are affecting the different indices out there as well, and how it's all related, and how it's all entwined, and how strongly correlated the macroeconomic, the communities and the capital markets are at the moment. So this is a chart of dollar yen. Now I've chosen dollar yen because I think it's a good representation of what's going on with probably the most ultra-aggressive central bank out there at the moment, the Bank of Japan. The Bank of Japan are doubling their money base, so they are increasing the monetary supply that's out there. For those of you taking photos, that's fine. I just will tell you this. We are sending you out a note on Daryl's and mine's trading ideas and trading handbook. But we also, potentially, if you want them, we will send you these charts and these slides, and I think Daryl's kindly suggested that he's willing to send his slides as well. So you'll be getting 3 sets of slides at in the email that potentially come tomorrow as well. So you can take photos, that's absolutely fine, but we will be sending you these slides for you guys to have a look at as well. So the Bank of Japan have come out with this ultra-radical, ultra-aggressive monetary easing. They are doubling the amount of money and supply in the economy. What does that mean? It has a huge dilutionary effect. But why are they doing it? Why are the Bank of Japan trying to double their monetary base? Well, a very simple solution. Well, it's very simple to say. Whether it actually achieves it is another thing that the markets are trying to suggest and trying to work out. They are trying to create inflation. Okay? Japan, as we know, has been in deflationary cycle for a couple of decades now. To change consumer behaviour in Japan is a slow-moving ship. It's a very slow-moving ship. But as you can see from the trend, the market since November last year seems to believe there's a change coming on, seems to believe there's inflation expectations. And the Bank of Japan themselves are using expectations as a monetary policy tool. It's brilliant to see. The Fed are doing a very similar exercise at the moment, but the Bank of Japan are using CPI and inflation expectations as a monetary tool. Now, one of the ways I like to trade is using momentum. You know, I believe that a currency in motion stays in motion. I like to add to winning trades. I never look to add to losing trades. Dollar yen's been a very, very interesting ride. As you can see, it's been making higher highs. And we've had a nice recapitulation. We've had a nice move down as some of those big extreme long positions came out the market. Now, the key for me is just the strong correlation between dollar yen and Nikkei. If you were to pull up a chart of the dollar yen and Nikkei together, which I unfortunately haven't done, you would see they pretty much work tick for tick. Dollar yen moves up, the Nikkei moves up. And the reason for this, the main reason for this, is that every 1 yen that dollar yen moves up, every 1 yen that dollar moves up, let's say it goes from 101 to 102, translating to $2.7 billion for the top 30 export companies. So as we're seeing dollar yen moving up, the profitability for Japanese companies increases dramatically. So you are seeing dollar yen and the Nikkei pretty much correlated tick for tick. It's a very, very interesting ride at the moment. Now, what we're starting to see is a real improvement in the Japanese economy because of some of these efforts that the Bank of Japan have been doing. You know, as I say, they're doing this huge, huge expansion of the monetary base. As a percentage of their economy, there's been no more aggressive central bank action out there. They're also doing fiscal reform. There's bits and pieces to do with fiscal reform. And then there's supposed third arrow, which is structural reform. You know, they're giving new powers to ladies and women in their economy. They're looking to try and make their economy more competitive against global peers and other bits and pieces. And I reckon, and certainly a lot of people in the market right now believe that we are seeing a change in Japan. You're seeing, if anyone saw the Tankan report, the business confidence numbers that came out today, very strong. The GDP numbers recently, really strong. You know, PMI numbers, manufacturing numbers, very, very strong indeed. So we are starting to see economic data in Japan actually start to translate into economic growth. And that economic growth is really, really important because if we do see inflation forces coming out, then we are going to see bond yields moving higher as well. Now, for anyone who follows the bond market very, very closely, and I think if you're a currency trader and you're working purely on fundamentals and as a strategist, you have to know what's going on in the bond market. The bond market, for me, in the US bond market is the center of the world. Okay? It's the absolute epicenter of the world right now. The Fed, as we know, are looking to taper their bond purchases. I'm not sure if anyone else there is absolutely sick and tired of hearing the word taper. It's not a word I used 6 months ago, and it's a word I use every day at the moment. But right here, this is a chart which shows the correlation between dollar yen in white, which we obviously saw in the previous chart, and this is the US 10-year against the JGB bond spread. Now, as a Japanese bond, if I'm a Japanese investor, if I'm a retail investor, if I'm an insurance company, whoever it is, I'm looking to chase yield. I want the highest return I can possibly get out there. Right? So if US Treasury yields are moving higher, because the Fed are coming out of the market and trying to normalise policy, we're seeing stronger growth in the US, you see bond yields rise. Now, the yield advantage that you see in the US against what you see in Japan is now what's making dollar yen move. So as yields move up in the US more aggressively than they are in Japan, the yield advantage which you're seeing there, or what we call in the currency markets a yield spread, makes the dollar more attractive. The higher the yield as a fundamental strategy, the more compelling to hold that currency. Okay? High yields are because of economic growth, therefore you're going to see the likelihood longer term that we see a normalisation of rates. So that's the one thing that we look at in the currency markets very strongly. What's the difference between a Japanese government bond, whatever maturity it's going to be, against that in the US? And as you can see, the yield advantage on this orange one of US Treasuries has been going up and up and up. So from a fundamental perspective, you could make a case that dollar yen should continue pushing higher. Morgan Stanley, UBS have got a year-end target on dollar yen of 110. We're currently sitting around 99 at the moment. So if you believe their longer term targets, which will involve moving higher in yields, there's still a lot of good upside in dollar yen, and therefore you'd probably say that the index in the region to be leveraged to at the moment is still going to be the Nikkei. This pretty messy looking chart is belonging to what we call the second most aggressive central bank, but probably the most interesting thing for this central bank at the moment is we are seeing a normalization of policy. This is the US. Okay, so we saw Japan, who are just starting to really ramp up their bits and pieces with the monetary policy, and we've seen a massive reaction in dollar yen and bits and pieces. The Fed were the first in the market. 2009, they came out of their QE1 program. 2010, they came out of QE2. September last year, they came out of QE3. Now they're going to be the first central bank to really come out of the back end and start normalizing central bank policy. So at the moment, they're buying $85 billion in US treasuries and mortgage-backed securities. Why are they doing that? They're trying to reinflate the economy. They're creating money, which creates inflation. Supposedly, it's trying to create jobs, and they are doing a pretty good job. The Fed are creating jobs. The last 6 months in the US, they've averaged about 195,000. Any of you short-term traders are looking out for a trade, this Friday, the non-farm payrolls will be in focus. It's going to be a massive situation. It's all about jobs in the US. So the US have done these different QE packages, QE1, QE2, and QE3 over the last 3 years. Look at this chart here. This is the S&P in white, and this is the Fed's balance sheet in orange. Okay, so as the Fed's balance sheet expands, as they print money and look to buy these assets, US treasuries, mortgage-backed securities of different durations, the correlation here between the S&P and the Fed's balance sheet is all for there to see. So why were the markets nervous when Bernanke said that they could potentially look to taper this year? Well, why do you think? If the balance sheet's not going up and you've got this correlation, people are concerned that this stimulus that the equity traders and global traders are so addicted to may come out the market. This is the bond market as well. This is the yellow one. This is the 10-year bond market. You can see this has been moving up. This has been moving up because people are concerned that the Fed, who have been buying US treasuries to try and keep yields low, are going to come out the market. Now, they've been buying US treasuries. When you buy a government bond, you know, price goes up, yield goes down. Now, if yields are going down, everything in the US is priced off the US bond. Okay, everything. Municipal debt, corporate credit, loans, mortgages. In the last 2 months, since the beginning of May, the 30-year mortgage for Fannie Mae and Freddie Mac, who are the guys who issue mortgages to people, have gone up by about 1%. Represents about a headwind of about 0.2% to GDP. The concern now is when the Fed will look to taper. And September seems to be the date that they're going to cut back on that $85 billion a month. But I actually reckon it's a really, really positive thing. You know, the Fed are coming out and they're potentially going to lower their asset purchase program, potentially going to finish this and have a normalized balance sheet, or they're certainly not going to be adding to their balance sheet, probably mid next year. That seems to be the market's consensus. But is that not a good thing? That we don't have to rely on stimulus anymore? That the US is growing at such a strong rate that they can survive with their 2 feet? I reckon there's a situation now where we've got this really, really sweet spot for equities, where you've got the Fed saying to themselves, you know what, we're going to taper because we think the economy is strong enough to create organic growth, which is good for companies. But at the same time, if the prospect of deflation comes through, if the economy slows down, if we hit another soft patch because of the sequestration, then they can look to ramp up their asset purchase again. We've still got that Bernanke put that's kept the market so nicely put up. In terms of what the market's pricing in terms of the US, you can see here at the moment the Fed funds rate, the interest rate that the Fed uses, is pretty much zero at the moment. This is what markets are pricing in at the moment. So markets believe by 2018 we will have interest rates in the US at 3.5%. That's fine. Now, as a trader, I'm a short-term trader. How do I trade that? It's very difficult having a 3 or 4 year view. But as investors, you can look at this side of things and say to yourself, how will the world look by 2018? Now, having a crystal ball out to that side of things is fraught with danger, it's fraught with difficulties. But for me, if the Europeans are still going to look to keep policy accommodative, they're going to still have issues probably by then in my mind, and the Fed's going to have a 3.5% interest rate, I'm going to be looking at ways to invest around a 3.5% rate. The dollar's probably going to be stronger by then. In Australia, where I live, I'm looking at companies with that dollar exposure, who has that revenue base in the US. And this is quite interesting now because it basically shows the market's now expecting the interest rates in the US to ramp up quite aggressively by 2018. So I'm looking at ways to express that in the currency markets, I'm looking at ways to express that in the fixed income markets, and I'm looking at ways to express that in the equity market by being leveraged to companies which have strong exposure to the US and actually do well in a rising rates environment, such as insurance companies, such as banks, for example. Now what we've seen, I'm not sure how many of you actually trade gold. Gold's one of our most traded products at IG. We have a lot of Asian clients, a lot of Australian clients trading gold at the moment. It's very much in focus. Momentum traders have liked to trade gold because it's in a very, very strong downtrend. It's making a series of lower lows, as you can see from there. It's breaking through some key technical levels on the weekly chart. This is a weekly chart that I've got out. I've just looked to increase my time frame a little bit longer. But you can see that, so this beautiful double top broke through there, and we've pretty much traded down to the sort of the technical targets we've been seeing there as well. So for me, from a fundamental perspective, there really is not a lot of reasons for me to want to own gold at the moment. The reason I don't like gold, and certainly I'm not suggesting anyone should go and sell it, that's not what I'm saying at all. It takes two to make a market. The reason for me, in terms of gold, opportunity costs. As I talked about at the moment, we are seeing rising bond yields in the US because the Fed are coming out the market, or the perception is the Fed are going to come out the market. The world seems to be improving slightly from the days where we're going to see a European breakup and all these bits and pieces. But bond yields are moving up. And bond investors are saying to themselves, and investors all around the world are saying, I can get a yield now. I can actually get a return in the bond market. And when you adjust a 2.5% 10-year bond for inflation forces, we've got positive real yields. Gold does very well when you've got a negative real yield. So if you've got a situation, let's say you've got a bank account, and when you adjust that bank account rate for inflation, some people actually lose money holding money in a bank account. That's called negative rates. It's the same in the bond market. If inflation forces are higher than what you can achieve in the bond market, that's what you call negative rates, negative real rates. That's a really good place for gold appreciation. Right now in the US, if you look at the 10-year bond against inflation, if you look at the 10-year bond against inflation expectations, because remember, if I'm holding a 10-year bond, I'm probably going to hold it till maturity if I'm BlackRock or PIMCO, then you've got positive real yields. That's a very bad place for gold to be appreciated. You know, you're missing out. It's opportunity cost that you're missing, hence why you're seeing markets coming off. What I will say, if there's any gold bulls out there, and I'm sure there are, you're fighting a very strong trend for one thing, but from a very positive perspective, you've had a massive, massive shakeout of net speculative position. The hedge fund community have increased their short positions. Every Tuesday, hedge funds and speculators have to send their positioning to CFTC, who then put a report out on Saturday, which tells you net positionings of traders, okay? So net long positions have just come right down. People have had this huge clear out of net long positions. So from a positioning perspective, gold positioning has come much more to a favourable level. From a supply issue, the big falls that we've seen in gold prices, we're actually starting to get below the marginal cost of production. We're now seeing a supply-side response. So you're seeing gold miners, which only increased their production globally by about 2% last year, are actually now starting to cut production. What does that mean? It puts upside pressure in gold. So those things for me are really, really important. The Fed are coming out the market. So holding gold as a hedge against the debasement of fiat currencies hasn't worked. It hasn't worked since that downtrend. You're seeing a normalization in the US as long as economic data meets their targets. Now we've got to remember, everything in the Fed is evolving around the Fed meeting their economic projections. Central bankers are terrible forecasters. They're terrible. If they were good, they'd be working at investment banks getting decent wages. The Fed are terrible. I'm British. I've got to say the British central bank, the Bank of England, are probably the worst ever central bank forecasters. They've missed their targets for about a decade or so. They're absolutely terrible forecasters. The RBA in Australia are rubbish as well. But the US, they're premised on trying to reach growth of 3.2%. A lot of people are sceptical about that. So again, that's another reason you potentially hold gold. But you can see you're finding a very, very strong trend at the moment. Now I'm Australian. I'm English. I live in Australia. I thought I'd chuck in a few slides. I'm not sure how many of you out there trade the Australian dollar against the US dollar. It's been a very strong trend down. It's absolutely collapsed. In fact, this year it's down about 13%. A lot of people out there still think that the Australian dollar against the greenback is going to get hammered this year. I think there's going to be a lot more downside down there. NAB, one of the big Australian investment banks this week, came out and said that the Australian dollar can fall to about 84 cents next year. The RBA are not done cutting rates in my mind. I think they'll continue to cut rates. China's slowing down, and I'll talk a little bit more about China. Mining investment in Australia has peaked at 6.5%. And what the RBA are doing, the central bank in Australia are doing now, is they've seen mining investment really peak out. There's been this huge wave of investment from China looking to buy Australian raw materials for a number of years. Now, the domestic economy in Australia is pretty weak. Yeah, we're pretty much seeing recessionary forces. People in Australia are not buying products. Yeah, they've been saving, they've been looking to deleverage where they can, but the mining investment side of things has kept GDP supported. You know, that's why we're called the lucky country. I'm sure people have heard that before. But now people are starting to see that side of things roll over. China are not buying as much raw materials as they were. And people are saying, is the mining side of things over? Is the domestic side of things going to pick up the slack? So that's why we've been seeing really, really aggressive rate cuts coming through in Australia. We've seen 200 basis points coming off the cash rate since November 2011. The thing is, from here, when we're seeing sort of sideways price action that coming through in the Australian dollar, a lot of central banks around the world in emerging markets, parts of Europe, were buying our bonds because we have a AAA rated bond. Very secure. There's only 7 nations in the world which are rated AAA by all three different rating agencies. Very, very compelling place to be. You're pretty much guaranteed to get your money back. Well, that's the theory anyway. The question now a lot of people are asking is, okay, fine, they've still got this super AAA, but are these reserve managers going to be the ones who are going to keep supporting by buying Australian bonds? And of course, when you buy Australian bonds, you have to buy the currency as well. So there's this theory out there at the moment that central banks are not going to buy Australian bonds anymore. They've done what they need to do. There's going to be more rate cuts coming through in Australia to try and support the domestic economy. Commodity prices are coming down. That affects our terms of trade. And we're probably going to see one more rate cut this year. Again, you're fighting a very, very strong trend. So trend followers out there, you're seeing this very much leveraged to this currency at the moment. So that's a very interesting trade. You know, the view out there in the market, the consensus in the market, that next year this will continue to trade lower. And the other big thing that we've been seeing, and this has really affected the Australian dollar, and it's affected every single one of you guys as well, is what's happening in emerging market currencies. You've been seeing this huge, huge unwind of the carry trade. Now, if you think back from the different Fed actions that we've been seeing, where they've been looking to dilute their currency and look to reflate their economy, what did the market do? Reserve managers around the world, or certainly fund managers around the world, went out and sold cheap liquidity, cheap US dollars, and they went out and funded and went out and go and buy a high-yielding asset around the world, whether that's in Australia, where you could pick up a 3.5% yield in a 10-year, 5.5% yield in a bank, through Brazil, where they've got extremely high interest rates, parts of emerging markets in Asia as well, you can get some high bond rates as well. So you've been selling US dollars, and you've been looking to buy high-yielding assets in there. It's what we call the carry trade, and it's worked very, very well. It's I think it's ultimately what pushed the Singapore dollar down to about 120. Now, what's actually happening is we're seeing bond yields moving up quite aggressively in the US as the Fed come out, and we're starting to see organic growth. Is we're seeing an unwind of that carry trade. So the trade that did very well and pushed the Singapore dollar down significantly is now being unwound. As we see that US dollar coming out, the US Treasury yields moving up, people are coming back into US dollars. They're selling out of Singapore dollars. They've been selling out of Brazilian real. They've been selling out of Indian rupee. They've been selling out of the Australian dollar. And they've been coming back into the US dollar. So anyone wants to know where dollar Singapore's going needs to look at what's happening in the US 10-year Treasury. If we see yields pushing up to 3%, you are going to see dollar Singapore continue to go higher, and the Singapore dollar will weaken. It's a fact. It's a fact that's been happening. Every week, as a currency trader, I like to know what's happening in the positioning in the markets. Now, I just mentioned what's happening with gold, and I talked about futures positions that are happening in the market. Every Tuesday, as I say, hedge funds, speculators have to come out and tell you what they've done with their holding. Anyone who's trading the Australian dollar at the moment, and it's been a fantastic trade, the thing that I'm quite concerned about being holding shorts at these levels is the fact that we've got record shorts on the market at the moment. This is the correlation between the Aussie dollar in white, and this is a weekly chart, against the positioning in the market you can see here. As you can see, there's never been a time when the market has held more short positions at the moment. What is a short position? It means I've made a negative bet. I believe that the market's going down, so I profit from a move down. That's what we call holding a short position. If we see good data, if we see some positive information, how do I close that position? I have to buy it back. Because I'm short, I'm expecting a move down, I have to buy it back. Now, one thing I am concerned of and cognizant of when I am holding a short position on the Australian dollar is positioning. And it's something that a lot of people are quite concerned about at the moment because we have record shorts. Now, it's not something that I would actually go and trade against. I would not buy the Australian dollar purely because they have this huge short position and this huge short interest that's in the position at the moment. But it is something to be mindful of. If you're a strategist, if you're trading on a strategic view, this is something that you can add to your sort of bow. You know, you've obviously got to look at the price action. You've got to look at you've got to know when to get in, when to get out, and manage your position when you're in the trade. But this is something that you can look at the moment. How's the market positioned? And it's something that a lot of traders look at, and it's something to be careful of. Now, China, very, very interesting indeed. Now, one of the big things that's been affecting the macro markets recently is what's happening in the interbank market. Now, I'm not going to spend too long talking about China because I could be here all day. China's going to grow at about 7.5% this year. The big concern in China is that they've always set a target, and since 1998, when the previous Asian financial crisis happened, they've always exceeded their targets. They always have these internal projections for core PCE, or CPI should I say, and growth. People are concerned that their 7.5 target is going to be missed. Now, what's actually been happening in China is there's a huge amount of leverage in the system. The banks, the shadow banking committee, have just been spending on infrastructure, issuing loans to local governments, to companies around in China. And the situation now is there's too much credit in the system. There's 198%, credit equals about 198% of GDP in China. It's just crazy place to be at the moment. So the PBOC has said, right, we're not worried about growth anymore. We're not too concerned about growth. We need to de-risk and de-leverage the financial sector. We need to create and remove the bubble that's in there at the moment. So they're imposing different strategies to remove the financial risk. Now, that's a very positive thing. You look at what happened in the US. The shadow banking committee were rife. They were issuing loans left, right and centre up until 2008. And we all know what happened in 2008. Some risky bets on the mortgage market burst. Bang, we saw property collapse. We don't want that to happen in China. So the PBOC has said, right, we can still manage growth. We're not going to as much. We're going to remove the financial instability. We're going to remove and lower the credit that's in the system. Of course, lower credit means lower growth. So China will probably grow about 7.5%. But the concern of understanding about this deleveraging cycle has seen the credit markets moving up quite sharply. This here is the 7-day interbank market. So it's what banks lend to each other for a short period of time. You can see the massive moves we've been seeing in the credit. We've traded between 28% and 5% in one day. That is stress between the banks. The banks are not lending to each other. It's very similar to what happened in Bear Stearns. It's very similar to what happened in Lehman Brothers when the banks worried about what was on each other's balance sheets. Similar sort of thing that's happening in China now, but the PBOC are keeping the markets reasonably liquid. We're not going to see a collapse, but we are going to see slower growth in China. And ultimately, that's what the market was concerned about last week. Another way the market likes to play the lower Australian dollar and the fallback that we're seeing in China is playing the Aussie Kiwi. Aussie Kiwi, for me, is probably one of the best pairs to trade because it removes the market risk, the risk-on, risk-off thematic that's hit currencies. You know, if the world's falling apart, you go into the US dollar. I like to trade the Aussie Kiwi because you're trading two currencies which trade off pretty much the same thematic. So you remove that market risk, you remove the beta that's in the trade, and you're trading one economy purely against another. And the reason I like this as well is because you've seen this really nice break of this technical pattern. It's come down, failed break, come back, tested it, and the technical target on that could be around 110 over time. Now, for me, I still like, of the commodity currencies, I still think a lot of people like the Kiwi dollar because they've got a really high property market. Their property market's on fire at the moment, and potentially could raise rates, or they're going to do some other bits and pieces, whilst I think in Australia we're still going to see some pretty aggressive rate cuts coming through. So you can see there's been a very strong trend, a series of lower lows and lower highs coming through. It's broken and closed below the neckline, and the technical target in that, a lot of people are suggesting, could be down as 110. We're currently trading around 118 at the moment, so I think that's an interesting chart. Again, it's just thinking outside the box as traders. It doesn't have to be against the US dollar. You can trade the crosses as well. They're very interesting and very exciting places to be as well. Now, I've got about 10 minutes or so, I think, about 10 minutes. I talked earlier about QE. Now, it's a bit of a messy chart, I'm sorry about that. But I thought what would be quite interesting exercise is to look at the currency moves in euro-dollar. Now, euro-dollar is the most traded currency in the world. It's the most traded currency pair by quite a long way. The liquidity in there is huge, and it does about 60% of the day's turnover in the G10. What I thought would be quite an interesting exercise was to look at the moves that we saw in euro-dollar when we saw the QE1 and QE2 come for an end, and just see how people traded then, and when potentially we could have a repercussion when QE3 came out. We talked about earlier about the Fed potentially coming out the market and starting to look to cut back on the pace of asset purchases in September. One of the New York governors came out last night, on Friday night, and said that September was a possible date. So the market now has got it firmly in their head that the Fed will come out. The question is, it's about timing. It's about timing. As traders, you can have a fundamental view, but you need the price action to come in. Now, I work very much on what we call a techno-mental basis. I like to have a fundamental view, but I won't trade that unless the technicals and the price action are telling me the same thing. There's a long-running view. If you are a fundamental trader and you have a fundamental view and a technical view that tells you very differently, no trade for me. I'll back the technicals every time. You need price action to tell you what's going on. In the currency market, there's just too many moving parts. They will blow you out straight away. So what I'm looking at here is QE1 started back here in early 2009, and of course the dollar weakened up there. So we saw a massive move up to 151 in euro-dollar. QE1 finished around here, and we saw it moving down to about 118. So a massive, massive move, about 22% in euro-dollar. QE2 started there. We actually saw dollar falling. And then QE2 finished. So the last two times when QE has finished, there's been about a 21% move. That's a massive move. Now, stock traders out there, if you come up to me and say, manage my money, and I gave you a 20% return, you'd be pretty happy. You'd be okay with that. But if you came up to me with your money and said, Chris, can you manage this and trade euro-dollar, and I gave you a 21% return with 100-to-1 leverage, which is what you get in the currency markets, you'd be a lot more happier. That's a huge move. Now, that was also premised when we saw potential for Greece to default on their money, and potentially we're going to see a split up of the Eurozone. So maybe these sort of situations won't happen again. But the question we've got at the moment is, will this sort of move happen when the Fed start normalising policy? Will the Fed start coming out, and will we start seeing this massive move again? Am I pretty much done, am I? Yeah. 5 minutes, cool. So well, that's the question for the markets. Now, from a fundamental perspective, I'm saying to you, like, why is the euro-dollar up at 130? Now, growth in Europe now is at what? Contracting at about 0.4%. You've still got these political issues in Europe, and for me, that's a major situation that we need to look at. You've just seen an uprising in Italian politics. The guy who came third place with 15% of the votes in Italy was a previous comedian. In Greece, one of the parties that polled really well was a party called Golden Dawn. They're a far-right party. Their motto is kick out the scum. They want to put landmines between Greece and Turkey. You know, Spain, there's protests pretty much by the day at the moment of the austerity measures that's coming through. Now there is a slight ease of that going on at the moment. Europe's not solved. Europe's not solved at all. And the big thing that we need to look out for is the political uprising that's happening in Europe. We've got an election in Germany in September, and the second place party at the moment is called the Alternative of Germany Party. Their motto is they want to leave Europe. Now, if Germany leave Europe, I want to buy the Deutschmark. I want to buy it straight away as soon as I can. It's going to go up through the roof. But if Germany leaves, it's going to create huge instability. But they're not going to leave, and I think we'll be okay. There's other things that are happening in there around the ESM, the European Stability Mechanism. But Europe's not solved, and there will be political changes. And that's the thing that we need to look at as investors and traders as well. It's the political uprising and the change. You know, you've got youth employment in Europe, some of it 50%, above 50%. If you're aged between 16 and 24, you can't find a job. Now, a lot of that is black market politics. People are getting paid cash in hand to do these jobs, and it's not getting reported, so they're not getting the tax incomes. But that, for me, is going to be a major issue. Now, if the Fed are coming out, and I believe Europe will lag on growth, there's still a very good chance that by the end of the year, you could see euro down towards 120. UBS, Goldman Sachs have both got year-end targets on euro-dollar of 120 as well, to give you an idea about where people see that going forward. So for me, anyone trading euro-dollar, you've got to keep an eye on the bond market. If US yields are going higher, it's going to be good for the dollar. US fund managers have 45 trillion in assets. They are the biggest holders of money in the world. If they start buying more, selling out their foreign assets and coming back to the US, that's a huge amount of money coming back into the markets. Remember, currency markets work on outflows. It's the perception of where money's flowing from one economy to another. So I think that's going to be an interesting trade going forward. So just to highlight, because I'm going to have to, my time is up and we will have some questions. So Daryl's going to speak, but if anyone's got any questions, just write them down and we'll have a Q&A session afterwards, both myself and Daryl, so happily do that. But for me, yields are probably going to go higher over the next couple of years. And where would I invest right now? I'm not giving anyone advice at all, but for me, the market seems to be saying that the US dollar is still the place to be, both from an emerging market currency side of things, from an unwind of the carry trade, and also against G10 currencies. There's a lot of people out there saying now, if you want to be in the currency markets, it's all about the US dollar. So that's really probably the interesting side of things from a fundamental and probably a technical side of things as well now. So I'll hand over to Daryl. But if anyone's got any questions, just jump up afterwards.